On today's show, 3 questions. Number 1, why are the auto tariffs different? Number 2, is it time for a little perspective? And number 3, how much money do you actually need to live? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
I'm Rabih.
Yeah, you are. We're back at it, guys. We got the trifecta. Rabih and I have had quite a few just he and I podcasts.
I'm happy to be on.
Yeah, we're glad to have Jake back at it. I was saying, Jake, it's tough during these kind of like beginning of the year Q1 meetings with clients to get some of the advisors on. Totally get it, especially because Fridays are so busy. But it's good to have the trifecta back at it. Okay, Rabih, let's jump in. Why are the auto tariffs different?
Yes. So in case you guys haven't heard yet, there are new auto tariffs hitting, imports on.
I haven't heard anything about tariffs.
Have I heard about this, Rabih? I'm getting this question like 5 times a day.
Honestly, and every single week, like my go-to topic is talking about tariffs. So at this pace, if the tariff situation keeps going on, give it a couple of months and all of our listeners are going to be tariff experts because we want to try to educate them about it every single time. And we're going to run out of educational content.
Wait a second. People on social media already are, it feels like.
Yeah, I know.
People act like they are.
I know. Which is a bummer. But I am taking a perspective. I'm going to share with you a different perspective about tariffs this time. We're going to analyze all the tariffs that have been put in a summarized way. And you'll see that the strategy of these tariffs and the goals that they are trying to, achieve are kind of different. So let's just start with the auto tariff and discuss what's happening. The president on Wednesday, March 26th, said he'll slap a 25% tariff on imported passenger vehicles and light trucks, as well as on key auto parts, including engines, transmissions, and powertrain components. This is expected to increase the prices on vehicles between $4,000 to $15,000, depending on the model. Bank of America's estimate was around $4,000. The tariffs will kick in at midnight on April 3rd, and Trump has said that they will be permanent. So one day after the reciprocal tariffs that are due April 2nd. So this is the news. The market didn't really digest it lightly. As you can see, major indices have been selling off a bit for the last 2 days. But this is all to, incorporate higher costs and a slowing demand because of that. But I went into the notes to try to come up with, a narrative, a story for how these tariffs are evolving. And I hope you guys find it interesting. But we started the year by imposing tariffs on everything coming out of Canada and Mexico, as well as China, excluding, energy products from Canada. Then we moved on to have tariffs on steel, aluminum, semiconductor chips. Right. And then reciprocal tariffs happened in between. But we just finally ended up with automobile tariffs. And I don't know, but I noticed an interesting trend. The first set of tariff was attacking countries as a whole, regardless of what the product is. It's aiming at targeting a country. The second set of tariffs, the aluminum, steel, semiconductors, they were targeting intermediate goods. No one is going to go and buy themselves a gallon of crude oil to put it in their garage. Or a semiconductor, just to look at it. Those are intermediate goods that go into different technologies, different products and services. So they dissipate into the economy. And this last round of tariff is actually on a final good, is a car that
the end product
is getting tired. And the auto parts might be, new batteries, new, steering wheels, whatever stuff goes into cars. I sound very bad at cars right now.
Transmission, catalytic converter,
these stuff. So these are stuff that you will go, for example, to AutoZone and buy. And these are the stuff themselves that are getting tariffed, which is interesting from an economic perspective, because just as we've been talking about the economy multiple times, when a trigger happens that changes an economic cycle, depending on where it starts, has a different effect. Like if a problem started from the banking sector, it propagates in the economy differently. If it starts at the businesses, propagates differently than it starts with consumers, right? We've been seeing this phenomena very so often. So when we get a tariff impact happening on countries worldwide versus intermediate goods versus final goods, how are these different? So I did some more research, and here's what we can find. For the countrywide tariffs, and this is what the administration said from the White House's website. They said these measures were justified by citing national security concerns, including illegal immigration and drug trafficking. So the tariffs were there just as a political tool of punishment regarding national security issues, not economic. I know you're shaking your head, but this is the stuff that happened. The objective was to leverage economic pressure on neighboring countries to address broader security and policy issues beyond trade. The tariffs on raw material, or, in a sense, those intermediate goods, the objective was to safeguard essential industries deemed vital for national security and economic stability by reducing reliance on foreign raw materials. And then now the tariff on the final good, the objective is to stimulate domestic production and job creation by making imported finished goods less competitive in the US markets. So those are three different arguments. Will they all lead to the same economic consequence? We know that tariffs increase prices, but how does each one of these increase prices? And here we're really going granular into tariffs. Not all tariffs are created equal. Each tariff is going to have a different impact on the economy. Which is worse between these three? A tariff on a whole country? We'll
find out.
So it is interesting. We will find out. But if we want to look at them in terms of how does each tariff affect the business or the consumer that are consuming them, it's something very interesting to look at. When you do a countrywide tariff, this is not targeting a specific product. It's, everywhere, everything. So for businesses, the decision that they have to make is that they have to reroute their supply chains. The main impact of a countrywide tariff is a supply chain disruption. This doesn't mean, if you were importing, we can't say maple syrup because only Canada exports maple syrup. But if you're exporting, some chemical products, if you were getting those from Canada and Mexico, it's not illegal to import them, but you have to import them from other countries other than these two. So this doesn't affect the product itself as much as it affects the business operations and where you decide to source them and how will the businesses carry these costs on. This is the most vague way of how the tariff will propagate into the economy. Because if the businesses end up finding a much more efficient way to figure out their supply chains, maybe that tariff might not be a bad thing. But this is economic fictions, right? Because the market is supposed to be running at its full efficient capacity to start with. So it's very vague. It really depends on where they're going to get those products from a business perspective. And that will determine how much of a price hike will happen. When it comes to tariffs on raw materials, like aluminum, the semiconductors itself, those are intermediate goods. And those are going to be hitting all the final products that are related to them. At the base level, at an immediate impact, we might not be sure how is that bad or good. Because yes, aluminum might be 25% more expensive, but businesses have the ability to tweak their product, change the quality of their product to be able to absorb the cost of a higher aluminum, for example, or a more expensive chip. And that immediately on the first batch of products produced might not be felt by the consumer. So while a tariff on an intermediate good might not immediately increase the price pressure because businesses have some, room for creativity in between. On the long run, this is inflationary. On the long run, because when the consumers decide to, repurchase that product because, you finish with it, the product life cycle ends, you need to buy it again, the next batch is going to be more expensive than the last batch, given that the tariff is still in place. So on the long run, slowly, there is an inflationary pressure rather than an immediate price hit by a tariff on an intermediate good. So this is kind of the second level of how obvious it is what the impact of that tariff is going to be. The last one, which is why those tariffs on cars are different, is because it's not hitting an intermediate good. It's hitting a final good that is going to be felt by the consumers immediately. And that might not be inflationary pressure where in the market every single time, because you're not going to buy a car every single year, right? So it's not going to be a chronic inflationary pressure in the background, but it's going to be a very strong immediate hit to price levels as soon as they happen, which we're going to be seeing in car prices starting up. So the narrative, and I hope you guys found that insightful, because now we are getting to a terrain where policy we know exactly how it's going to pan out. When you impose tariffs on auto parts and cars and vehicles, etc., the price of cars is going to be higher. How much is a car as a portion of the average American budget? That is by how much the American consumer's discretionary income will be squeezed. And that means lower discretionary income on other stuff, and it might lead to a lower GDP.
Well, and very insightful, Rabih. I'm wondering too, we've said this many times, and I think we still stand by this of like, we know like the textbook type answers, right? Of like what this means. But you just alluded to it. Like, we don't know, like take the cars, for example. Like we don't know how companies in the US, like we do know the intention, I think, at least the stated intention, which is to like, just like with Trump's first term, to repatriate actual dollars into the US. I think he's trying to like kind of repatriate production into the US, right? I guess we don't know how companies are actually going to react to this. Like we know how the consumer is reacting, freaking out right now. We do know in the short term it's going to increase prices. But what we don't know is, A, does Trump, when he's out of office in 4 years and the next administration completely pivots and changes and basically reenacts everything, we don't know the long-term consequences of like how companies are actually going to react and the impact that's going to have. Like, what if, best case scenario, it does how it's intended, and these companies do start to produce more in the US, and it changes the supply and demand aspects of all this, and prices do come down, or whatever the whole purpose is. We just, I guess the bottom line is we don't know how this is going to impact over the next 5-10 years.
Yeah, definitely, because businesses have the decision of, a new different legal environment, let's just start producing in the US. But also businesses can be like, let's hoard some cash and try to weather a 4-year storm. Because building a new car factory, it might take a couple of years, just to get it to the same quality and same competitiveness that you do. Well, in a couple of years, the political landscape might change. And will that mean that that investment has gone in vain? So yes, it's going to be very interesting on which side of the narrative businesses are going to be betting on.
I'm glad you brought this up, Rob, because I think you guys would be surprised how many questions I have received about, hey, should I buy a car right now? Like, I think I might need a car in the next year or 2 years. Should I just get one right now in like the next month before car prices go crazy? Like, I've gotten a lot. Way more than you would think. So I wanted to talk to you guys about this. My question is this, Rob. You said, okay, we're putting a tariff on these car parts. It's going to make car prices go up. What if the American consumer just says we can't pay it? Like, I'm not going to pay 10 grand extra for a car. I just can't. My budget's already squished. I'm not going to pay 10 grand extra. So was there an outcome here where the companies are like, we're just going to eat the extra cost? Like this, there is a supply and demand thing here, right? If the American consumer is like, we're not going to pay a bunch of money for all these cars, the car companies do want to sell cars. Is there a world where they're just like, we'll eat this? Like, our profit margins are awesome now. We'll just lower our profit margins in the short term. We'll keep these cars at a reasonable price so we can actually sell them. And we don't see a huge spike, actually, like we think.
This is the battle royale you're placing here, Jake, which is what's going to make Americans actually stop spending? And would American companies ever sacrifice profits?
I don't know. Yeah.
Both are very unlikely, but it's a good point.
Think, if you're going like right now, I feel like, okay, I can see like there's this Honda Odyssey that I want to buy that's $45,000, but next month it's $65,000. Like, no, I feel like people are like, no, I'm not buying that. I'm just gonna buy a used car, and then what if car sales just go way down?
Rabih.
I would make the bet that Americans will go into debt to continue their level of consumption over deciding to cut down spending. But regardless, whether Americans go into debt to continue spending or businesses try to eat the cost, both lead to lower economic activity. Because once you're in debt, we're going to get to a point where, the I wouldn't call it the credit card bubble in big, bold, highlighted font, but I would call that discretionary income would be weaker, and that slows down demand. And if companies decide to take it out of their profit margins, well, they will still have to try to, tweak it somehow for their balance sheets at the end of earnings season look nice. And that includes layoffs, and layoffs means people spending less. So in both cases, people are spending less, and that's bad for the economy.
Yeah, so let's say, this causes some bad stuff for the economy. People are spending less. There's less economic activity. Does that naturally lower the prices of cars anyway? Right? Like, if there's less spending, I'm just wondering, I'm getting so many questions like, oh my gosh, our cars are going to cost 30% more in 2 months than they are now. I'm wondering if that's actually going to play out, or if like we go into a mini recession and all this stuff happens here, and we actually don't see the huge bump in car price. I don't know. I'm just guessing, theorizing here. I'm just wondering how this all plays out.
Textbook would say supply and demand. Supply is what is determined by the cost. Like if it is worth it if there's enough demand that it is worth it to produce at higher price levels because the parts are more expensive, then the supply is still going to be there. But if demand drops down and it's not worth it to create to produce these new cars, there won't be an incentive.
I'm wondering, does demand go down?
Supply and demand. So depending on how these two dance, we might see the price go up or down, but this is too many steps ahead and nods ahead for us to determine how it's going to go.
Like, do the automakers secretly love this? Like, are they getting like an awesome, they're essentially, the government is running a marketing campaign for these car makers to be like, hey, go get a car in the next month. Like, literally just go get a car.
And this is across the board, right? I just saw this article. We mentioned this a few weeks ago, but I just pulled it up again. I saw this come across it. This was published today. Tariff whiplash triggers surge in fear-based shopping across the US.
Yeah.
So people are out there. Like, it'll be interesting to see what the March numbers come in at for spending, because consumer sentiment is quite a bit down, but people are out there kind of this like fear shopping.
Spend all our last dollars. Exactly. Let's go on vacation. Let's get that car. Yeah, that's hilarious. Anyway, fun stuff.
No, this is great, Rabih. Any other thoughts on any of this?
No, to be continued, I guess.
Yeah, clearly the new theme of 2 cents, it's kind of pivoted over the course of 3 years. Now it's tariffs. It's just tariff talk.
We're going to start calling it tariff talk. Then
we
had inflation for a while.
Yep.
And now we have tariffs.
Tariff talk.
Fun.
Okay, well, with all this tariff talk, it's obviously led to a lot of fear. A lot of, Jake, I know you and I talked about this yesterday. You were sharing a specific story. We'll keep the details ambiguous, but just this is kind of across the board. People are nervous. People are, you can't turn on the news or really go anywhere without being kind of thrust into like the financial pornography network of just fear. And speaking of automakers loving this, you know who else loves what's going on right now more than anyone is mainstream media. They love this, and
they love the Trump presidency. Baby.
Don't get it twisted. They absolutely do. That is not a political statement. That is a capitalism statement. That both sides of the aisle in mainstream media absolutely love this. Ratings are up. People are tuning in. That's exactly what they want. So I thought it would make sense to maybe give it just a little perspective, but I want to start first with acknowledging and being empathetic, truly. Like, we understand, like, we are not sitting here saying you should not be afraid. We're not sitting here saying that it is totally normal to be feeling what you're feeling right now. All of us hate uncertainty. We hate it. And right now, uncertainty is pretty dang high. And so I understand we don't know where this goes. People are feeling it's going to get so much worse. The media is not helping, pumping this into us every single day. So we acknowledge that we understand the fear, and it's okay to feel this. But I also wanted to give a little perspective of just where we're at. So we'll start first with just maybe some historical perspective. We've referenced this a lot. A 10% drop in the market. We'll just use S&P data for right now. A 10% drop intra-year in the market happens about as often as your birthday. So to see a 10% doesn't mean the year it ends 10% down, but throughout the year to see a 10% drop happens about once a year. To see a 20% correction and actually see the market correct or drop 20%, that would be considered actually a bear market. That happens about every 4 to 5 years on average. A 30% plus happens about once a decade. So that's just some historical numbers. Any comments you guys have on that first?
No, yeah, it's speechless.
Right. Then let's give what's happening right now. Again, not even going historical. Let's just give, again, does the narrative match what's actually happening? Because Jake, I want to ask you, if you were just going off of the narrative of what you're hearing from clients or talking to people about and thinking about the news, I want to hear from both of you. What would you imagine is happening in the markets?
Yeah, it's like we're in dire straits, right? I mean, if I just read a few news articles, I'd be like, oh, we're getting, we're double digits at least, right? We're like in double digit correction territory, maybe 15% plus, somewhere around there. That's what it
Yeah.
feels like people are
Yeah.
feeling.
Rabih?
Yeah, I just read a survey yesterday about different age groups, millennials, Gen Z, boomers, Gen X, and what they think, how pessimistic they are. And the younger you are, the more pessimistic you are. That's the trend that's been showing. And there's really bad pessimism. It's like the world is ending according to the emotions, but on pen and paper, not really.
Yeah, that's a topic kind of for another day. But yeah, it's
Yeah.
the youngest generation should be the most optimistic.
Should
but
be
anyway.
the most optimistic. I know.
Yeah.
I'm with you. But so I'm with you. I think if you just heard the narrative, you see the news, you talk to people, it feels people are like treating this like an 08, 09 situation. So just for some perspective, let's go just kind of one by one, just giving 5 or 6 different indices. So the S&P 500, what most consider the quote unquote the market, as we've established that if you've listened to us long enough, you know this is not the case. This is a piece of the market. But the S&P 500 year to date is down 4.69%. Again, not great, but that is it's so normal to see a drop in 4 or 5% intra-year is not that crazy. Again, we know it's happened quickly, and that can be scary.
Yeah, I think it has been a little bit quick. It's been a slight anomaly in how fast
For sure.
big first drop was.
So we want to acknowledge that. But you look at the rolling 12 months, it's up 6.5% over a 12-month period. So just some perspective there. We'll go to the NASDAQ, hit harder. Tech's been hit harder, down year to date about 10%, just below 10%. But again, rolling 12 months, it's up over 6%. Dow Jones down a whopping 1.5%. Rolling 12 months is about up 5%. If you go international, so we'll start first with, let's start first with the international developed. So this is Europe, this is Japan, Australia. Year to date, up over 8%. Win for global diversification. If you look at emerging markets, so this is South America, this is Africa, China, Rabih, right? This is up 5% for the year. And if you look at all world, the all world index, say that 5 times fast, it is down 1% for the year. The other last thing I wanted to mention on this, and I'll get you guys' commentary. Since the Civil War, the US has experienced about 31 recessions, according to the National Bureau of Economic Research. In 16 of the 31, we've had a positive stock market in the US. So I just wanted to highlight that too, that if, there's always this fear of like recession, what it means, like the stock market and the economy, there is some disjointment there. And we've had over half of recessions in the US since we've been recording this data, that the stock market has actually been positive in those bad economic years. So I wanted to, again, acknowledge the fear, not just dismiss it, but also give some perspective. I want to get your guys' thoughts, if anything.
Yeah, I think with a lot of this stuff, do we just have a really short-term memory? I think
Yes.
like we're looking for something to talk about. For example, way back in 2022, how many years ago that was? Did you know the US stock market finished the year down 18%? You were down 18%. Intra-year was down like 27% at one point. Feels like we had less moaning and groaning then than we do now.
Okay, Jake, I'm glad you brought that up because I've thought the same thing. Like that was not that long ago, and I don't remember 2022 being this crazy year. Like I don't remember tons of questions from clients. I don't remember it being like this fear thing.
18% is a pretty big negative year.
Huge. It was
huge.
Yeah, almost a 20% drop.
Yeah.
But I agree. I don't remember it being this crazy. Now, again, we know this is political and what's happening with the current administration and everything he brings. Let's be real. Like that's it. That's the difference.
Uncertainty.
But I'm with you. I think I've referenced that with people before. Like, do you know, like just in 2022, we had a 20% drop in the market. Like it's not, this is normal. The numbers are normal. The narrative is not because of who's in office.
A 5% drop in the stock market happens 94% of all stock market years. So pretty much every year. So if this is something you're having trouble stomaching, again, we want to be sympathetic and it's, scary and things, but like this happens every year, kind of like every year you can bank on it. This is what's interesting to me though, is it feels like all of our fear is based on what could happen in the future. I just have a hard time trying to like create financial plans or investment strategies on what could or couldn't happen. I was talking to a client the other day, or that we were talking about some of the stock market uncertainty, and they said, I feel like I've been hearing uncertainty and scary stories for the past 2 years. Meanwhile, the market's been up 20% respectively in each of the past 2 years. And so you just never know. Like, I just hate basing, like, trying to change your plan or your investment strategy based on we're scared that Trump's going to ruin everything. I just don't like. It's almost like I want to confront problems when they actually happen, not before they happen. Like, let's not create imaginary problems. I don't know.
Well,
Rabih, I don't know what your take is
I
there.
want to get Rabih in here, but just to that point, Jake, how many times have we as a collective people said this time it's different? And in some ways it is. Like,
Well,
you
it's
can
always
point,
different slightly, right?
I
There's
was going
always
to say,
different players in the game. It's always different narratives. Yeah.
it is always different, but it is. There's always something you can point to that's different going back to all of history. There's always some flavor that's different, some leader that's different, some aspect of like what's happening that's different. But the constant progress and growth and innovation and people waking up the next day to live their life and improve their life, and that never changes. And so,
Yeah,
yes,
all past corrections, those were scary economic times too. People were uncertain then. Bad stuff was happening at that point too. It's always doom and gloom until it isn't, and kind of things recover. Like, yeah, into 2022 and in any correction in the past, there were uncertain and new things happening at that point too.
yeah,
It's
08,
kind of
09, are you
yeah,
kidding me?
it's always like, oh, this is new. This has never happened before, and the human capitalistic resilient mind just kind of keeps going on.
Yep.
It's pretty resilient.
Let's get
for a
Robbie
while.
in.
But
He's
anyway,
itching.
yeah.
He's
I
itching.
know, I am itching. Multiple points to address, but I agree with you guys. In 2022, the economy was in a much worse situation than it is right now. But the difference was the response to it. In 2022, we had inflation going up to 9.1% on the CPI, and that is much, much worse than what we think the impact of the tariffs. The impact of the tariffs is expected to increase 0.5 to the CPI. So if we're at 2.3, let's say 3, maybe of a CPI inflation right now, because it's much lower than that, but we'll go to 3.5. That's it. Whereas we were at 9 in 2022. The difference was in the uncertainty regarding the response. The response in 2022 was the Federal Reserve coming up saying there's an inflation problem. We're going to keep raising interest rates until we contain it. End of story. People knew that will be bad for the markets. The markets went 19% down, but because there was an certainty regarding the path of action, that it really did not freak out the public as much as, of the same magnitude as the Salah. Over here, the uncertainty of when the tariffs show up and will there be new tariffs tomorrow and will they be removed after tomorrow is what is causing the issue. But overall,
so Trump, in short, Trump is the dynamic that everyone's just freaking out about. They don't know what he's going to do. Yeah.
Over the course of, like, if you just look at the economic data, the economy is so much better in shape than it was in 2022. That is the first part. And I know people are freaking out about recession, but let me remind you what a recession is. A recession is 2 consecutive negative growth in a GDP. We still do not know how Q2 is going to happen. We might get Q2, which this is the last episode in Q1 for 2 cents. Q2 results are going to start showing up like in a week, 2 weeks from now, of what our expectations for GDP is going to be. There might be a chance that Q2 might be positive, and all this freaking out about a recession might be when there is no recession in the books according to how we measure a recession. This is possible. But also what is possible, and here's the reality check to everyone, that we might start seeing also negative growth of GDP in Q2, which affirms by the data that a recession is coming. So all this uncertainty and all this fear might continue for another quarter. And we should all be fine with it. And if we aren't fine by it, we need to readdress our financial plan, our philosophy, and why we are sticking to it. Just like it gave us less uncertainty when we knew that the Federal Reserve said, oh, there's this issue and we are dealing with it with a certain determination, sticking to the financial plan should be approached the same way to remove the uncertainty rather than worrying whether I should sell today, buy tomorrow, etc. So, and the last point I want to make is that your investment horizon is not ending in 3 or 4 years. Your investment horizon is much, much, much longer. And take these 3-4 years as a sunk cost if you're really worried about the market. Some people aren't. But if you're really worried about the market, just continue sticking to your plan for 3-4 years. And then look at the remaining 35 or 40 years beyond that and see where the growth.
That's the hard thing is I do think people are like, oh yeah, this will be a sunk cost. I'll lose some money in the short term. but you're not losing money in the short term. I mean, if you stick with it, if you're putting money into your investment portfolio every month or every quarter, every year, you are building shares, right? You're buying shares at lower points. And so when this rally does come and we make it out of this, again, it's funny we're talking about this. We're not even in any sort of correction or anything yet. But if we do get to that point, by putting money in, you're actually coming out the other side far better than you would have beforehand. You're getting more shares that will increase at a higher price that are going forward. And so like, it's not a sunk cost. It's actually a pretty great opportunity to keep building your wealth in the long run.
Yeah, our average listener, we know this of the ages of our listeners and clients we work with. You're a net saver. You're an accumulator for the next 20 plus years. You should be, if you shift your mindset, Jake, to that point, you are a share accumulator. The shares you can purchase just became cheaper. And that's what you should be thinking about is I'm just going to accumulate as many shares as I possibly can. You actually kind of want a string of bad years. But
you're just getting more shares, right? You're getting more investments in your account at a cheaper price.
Yes, you absolutely want this. And to your point, Jake, we're not even in, like we're talking like we're down double digits and we're not. And again, it's hard because we're not, again, we are wanting to acknowledge the fear that's out there, but it does not match reality of what's happening economically. We don't even know yet, to your point, Rabih. And in the stock market numbers that we see, again, the gift and the curse of the market is the transparency of it. But the numbers we're seeing are so normal. Like even for the scariest thing that's going on right now, it's just like, yeah, we're down 5% on the S&P. Like, okay, like that's a Tuesday. Like who cares? So we're just trying to give some perspective here. I also think, Rabih, as you were talking, I thought of Napoleon has a great quote. He speaks of military genius, but I think this applies to this as well. He says that the sign of true genius is the person who can do nothing when everyone else is losing their mind. And I think that applies so well to these moments of like, this is where the money is made. This is the difference at the end of your working career and the people that are accumulating and investing. The people who were able to stick to their plan while everyone else was freaking out and responding and reacting to what's happening around them, of which they cannot control. The geniuses, aka in this case, the people who build real wealth, are the ones that didn't freak out. And this is where it's tested. Like this is where you make the money, in my opinion.
My guess is there might be some listeners out there who are like, man, this Jake guy just never says a pessimistic thing ever. He's like, he's annoyingly optimistic about things are going to work out. And I'll accept that. I'll take that on. I'm probably going to lead into a little bit more. I mean, the reason I say that is we just have a whole lot of history that proves that's true. Like the pessimists sound smart, right? But the optimists make money in the end, right? Like just that's what history tells us. Again, if you're saying like things are going to be different, the government's going to collapse, we're getting a zombie apocalypse, sure, right? We'll be wrong on that front. But if we don't get some of those things, then yeah, it's like in the long run, you're probably going to end up making money. I'll plant my flag here. Okay, let's have me on this podcast at the end of the year. I think we're going to finish the year up in the U.S. stock market.
I agree.
You can bookmark this and people can attack me if that doesn't happen by the end of the year. But I feel pretty good about it. My, again, personal opinion, I do not know at all, right? So like don't stake your investment strategy on this. Yes. But if I had a guess, I mean, my personal opinion is I think we're going to end the year up. I'm going to say it.
I agree. Well, you know what I am betting on is that we're going to be up in 10 years from now and 20 years from now. And because I am betting on that because I keep investing. And I'm with you, Jake. We said this on the podcast yesterday. I agree. I think we're going to end positive. Just a total gut hunch, not saying I know this, but I'm with you. Rabih, we said this to him before we went on, and he was like,
I mean, again, Rabih might be right. He'll take the other end of that, which he might be right there. We'll see. Yeah. Let's see how it plays out over the next couple of months.
Yeah, I agree, though. I think we're going to end positive. It'll be interesting to see how it does play out. Let's finish up with this. Jake, I love this. Just again, we like to kind of cover different topics here. You wrote an article about this, which is how much money do you actually need to live?
Yes. Sorry, I wanted to share this with you. So I was on LinkedIn the other day. I browse like for 15 minutes every Monday. I don't know why I do it. Do I ever see content that benefits my life? Really never, but I still keep scrolling on there. But I did see a funny graph, actually a pretty cool looking map that was getting passed around. It was a map of the United States, and it showed the living wage for a family of four was the title. And it breaks it down by state. Okay. And I know this is not a visual medium, right? We're doing a podcast here. So I'll try to explain some of this. What would you guys guess is the highest cost of living state? Like where do you need to make the most money to have a living wage? Any guesses?
New York.
California
or New York?
It was actually Hawaii. I was kind of off, not the
True.
continental states there.
That
But
makes
it was
sense.
it was Hawaii. It was at $270,000, as they said, a living wage in
A
Hawaii.
living wage.
Yeah, it feels a lot. I'll get into the definition of this soon. So don't worry for like what's
How
a
much
living
was
wage
it?
mean.
Sorry, I missed it.
270,000, Rabih.
Ugh, okay.
Any guesses on the lowest state, like the lowest living wage required?
Was it Idaho?
No,
That's a good guess. It's in the South-ish, I think.
Alabama.
In West Virginia. I don't know if the West Virginia is South. Maybe people are offended by me saying West Virginia is South-ish. And so West Virginia was $82,000 was kind of the living wage to live in West Virginia. So we got 80,000 up to 270. That's in Hawaii. The state that was smack dab in the middle was South Dakota at $100,000 a year. That was like the 25th, so 100,000. So the point of this graph was there are actually more states now where in order to have a living wage, you need to make above $100,000. Right?
100,000 is the new 50.
Yep, 100,000 is kind of like the living wage number. Utah, where we live, is 128,000. California was 188,000. New York was 156,000. Texas, 96,000. Anyway, what I found interesting about this discourse was there was one guy who posted this, and there were hundreds of comments on this, like hundreds and hundreds. Like there was like 500 comments. And most of them were people saying, excuse me, $112,000 in Florida, that buys you like a cup of coffee and lets you breathe, right? Type of thing. Like these numbers are so off. The classic, like, inflation has killed us all. Like a family of four. Yeah, sure, this fits a family of four if you're single and your other three members are plants, right? Or a cat or something. Like, there was like a lot of the data and things there. Of course, I saw this classic, you have to have your political comment in there. Someone's like, summary, it costs a lot to live in a blue state. Classic, you have to have your political comment in there. So just for some context, this was like Go Banking Rates did this survey, and they categorized living wage for a family of four using the 50-30-20 budget rule, right? So they're saying 50% of your income should go towards necessities, 30% to discretionary spending, and 20% to savings. Okay, so they essentially said,
and these are all gross figures, is that right,
gross
Jake?
figures, yeah, gross numbers,
so
and for households too.
Tax,
households, and for households, families of four. And so they said necessities should take up 50% of your budget, right? So they said necessities are housing, groceries, utilities, healthcare, transportation. So they essentially went to each state and said, half of your budget should be these necessities. So what does it cost for your necessities? And they just doubled that number, right? So that's 50% doubled to get to this living wage amount, right? So they're saying, like in Utah, that's $128,000. They said all those necessities cost on average about $60,000, right? It's like what it costs. And then you need another 50% on top of that to pay for fun and entertainment and savings and things, right? I want to get your guys' initial reaction. Do you guys think like the average number was about 115 if you average out all the states, like $150,000 living wage? Do you think that's close to right for a household family of four? Do you think that's a little low, a little high? I'm just curious on your initial reaction if you had any.
My first thought, well, no, Rabih, go ahead.
I was going to attack the math.
Okay.
That's what I was going to do.
Attack the math. Let's do it.
It seems logical that they took the needs and they multiplied it by 2.
Mhm.
But tell me someone who does not spend anything on wants. Some people even, cut short the needs just to be able to enjoy the wants. So for me to just be a little bit more comfortable, I'd say a living wage is a wage where you live paycheck to paycheck and you do not save a penny. So give me the needs, give me the wants, and multiply that by,
Yeah.
Or 1
Yeah.
point.
So you say a little higher. You say this is a little lower number because you need to factor in
Yes.
some of those wants more than multiply by 2 to be comfortable.
And
to have
savings,
some
you're saying.
Yeah, and some savings. Yeah.
Yeah. My first thought, just with the audience we have, is I hope this is a good perspective for the dental audience.
Yeah.
Truly.
Yeah.
Because we see the numbers of dentists, and, I think I personally, even for myself, I'll call it out. Like I see this stuff, and I think I like seeing it because it does give me perspective of whenever I get into those moments of, I need to, we all do, like, oh, I need to raise my income, or I don't have enough for this, that, or the other. It just gives you healthy perspective of like, I'm doing okay. Like we're doing okay. And hopefully dentists can hear this and be like, okay, like, our average client we work with that's a practice owner is making like 500 grand a year. So again, it's all relative. You're referencing your circles and all that, but that's my first thought. To your question, Jake, I think it's probably like, again, if we're saying living wage to Rabih's point, like,
and they're categorizing living wages, you have enough for your necessities, discretionary, and a 20% savings, right? So the average savings in America is 3%, and they're giving you a 20% here, right, under this budget formula. So they're saying living wage of like, you can live and you can save and you're doing okay.
I don't think the math's mathing on that then.
Yeah, so you think it's a little low then, if you want to do all those things.
If you're saying a 20% savings rate
That's what
and
they're
have
saying for here.
your
Yeah.
necessities and, to Robbie's point, all your wants, whew,
For
I think
family
that's
of
probably
four.
a little low for a family of 4. I'm going
Yeah,
to
so about
guess.
115, 120 average in the US is kind of where that's showing
Yeah,
here.
I mean,
This is
let's
gross,
just.
so I got to factor in taxes. Every
I was
state's
going
a
to
little
say, so
different
we're saying
tax-wise.
115. What are we saying an effective tax rate there? An effective tax rate
25%, 20,
25,
25. Probably
maybe
normal.
maybe even lower than that.
It's probably lower. 20 is
Effective
probably.
tax rate. Let's just be conservative. Let's say it's 20.
But I
So
feel people are
23
eating,
grand going to taxes. What?
mac and cheese every day, and that's how they're like. It doesn't add up. No way.
So let's say after tax, you're talking about 92 grand after
Family of
tax.
4.
And then let's say you're saving 20% of that. So now you're talking 73 grand the rest of the way for everything. So that's let's say 50%, third to about 36,000 a year. So that means they're saying about 3 grand a month for all of your necessities, housing, food.
That's for one person, yes. For
Yeah.
4, no way.
I think those numbers are low.
Okay. Yeah.
I think I agree with the people.
Yeah, that's what the people said. So that's spot on there. The point I wanted to make more than anything with this is I don't think numbers like this have any real practical value for us. Like, they're great at online discourse, right? Like creating these debates and getting hundreds of comments and getting people mad or whatever. But the thing that's so hard about personal finance is it is so personal. It's very unique. Like, everyone's budgets are different. For example, some people may have student loans while other people had parents who pay for college. Some people may have aging parents they need to care for that's not factored in other people's budgets. Some people could have a 3% mortgage rate or a 7% mortgage rate in the same neighborhood that makes your budget vastly different. Maybe you have multiple teenage kids and you have a huge grocery bill that someone who's just living single or a family of 2 does not have. Maybe you have chronic health issues and you have to go to the hospital a lot. Meanwhile, there's other people who have never been in the hospital since they were born, right? So
maybe your hobbies are different.
Yeah, hobbies are different.
Hobbies are going to be different.
Even on the necessity point, though, even if we forget like spenders versus non-spenders, just like necessities of life, all of us vary on just different debt payments or health issues or family size or housing costs. And so it's like these numbers are kind of fun to play around with and talk about, but they get a lot of people mad. But I do think there are people out there, like there were some comments that are like, hey, I make $50,000. I have a family of 6 and I'm comfortable. Seriously, that was comments on the thing. Like, I'm actually fine at 50 grand in where I live in Idaho. And then there are other people, some of our clients, who may be like, I am making $400,000 a year and I am stressed out of my mind, right? Because of all my costs and things. And so I think it's just hard to, like, if we're trying to identify what's a living wage that every American should make, I don't think we can find a number. I think it's so unique and everyone's situations are so different that sure, this stuff is fun to talk about, but I don't know if there's really any real practical. And that's kind of the beauty of personal finance is you can make 70 grand a year and I'd be a family of 4 and feel like you're comfortable. And someone can make 200 and feel like they're comfortable there. I like that about personal finances. It is personal, dependent on your goals and your situation.
It's true, Jake. And this is a good reminder of like I think what happens a lot in dentistry, I think this is human nature, but just the comparison to other people, the need to be like, what's going on with them? What are they doing? I think that, to your point, is not super helpful. It's not helpful to your actual situation. It's what's personal to you and what lifestyle do you want. And yeah, but to your point, those comments, I've seen this before too. And I know people personally who are living off of way less than that. So I guess it kind of contradicts my point of saying, generally speaking, that seems kind of low.
Yeah.
But I hope
that's the majority of the comments are like, oh, that's really low. But there are people out there who are like, hey, I'm doing it and I feel just fine and I'm happy with my life. It's interesting.
All comes back to lifestyle. Because to your point, we know dentists who are making 500 grand plus who are stressed, who are like, because their house payment's 15 to 20 grand.
And to be sympathetic to dentists, oftentimes you may have a practice loan and student loans and things like that the other average person does not have. And so that's why context is needed as well. Like, you can't just look at the overall number. What debt payments do you have? How big is your family? Where do you live? All of those things.
Totally. Yep. Rabih, you got thoughts to finish this up?
My comic brain has been playing a scenario in my mind to just, it's an exaggeration, but tells you that this exercise that we're going through is not a logical mathematical exercise, but as an emotional exercise to compare ourselves to each other. Because if you take the emotion out of it, you take the human and you decide to, do it as businesses. There are two businesses, a couple of businesses in a neighborhood, and they're all wondering how much each other business makes. And you won't hear the business that makes less money saying, if I do not make that business that amount, I need to close my shop and just the equivalent of it in a human, just end my life. Like, it doesn't happen that way. The business would decide that what should I do in terms of my income statement, my expenses and my revenue, to make it work at the end of the day, to make sure I have a profit. Humans are not looking like that. Humans are looking at the headline number and saying, oh, this is too much, this is too little. This is not the logic. This is emotions at its best.
So true. And
if you asked 100 different people, what do you think of living wages? You're going to get 100 different answers. Probably.
But
That's
if
why
you
this is
ask
so hard to nail
100
down.
different businesses what's a good revenue, they'll be like, the one that allows me to make a profit. That's it.
Well, and there's been studies on this around not only what a living wage is, Jake, but what amount of money do I need to be happy? There's been studies on this that almost always it's based on the reference group you're using. It's based on the neighborhood you live in, the friends you have. Like, it is all comparison, to your point, Rabih. It's all emotional. It's not pragmatic. What do I actually need to live a good life? So, you know who you should be comparing yourself to, though, in my opinion, it's a healthy comparison, are the people that are coming to the Dentist Money Summit. Like, I think if you're comparing yourself to those people who are, I've been told, are the greatest dentists in the world, I think is what I've been told by all the greatest people.
I've heard that. People are saying that.
They are saying that. A lot of people are saying that. There's actually a lot of data to back this up, that the coolest people in dentistry are coming to the Dentist Money Summit June 20th and 21st in Park City, Utah. So if you're looking for a comparison that is healthy and that you should be, actually using as far as like a template of how you should live your life, it's follow the people that are coming to the Dentist Money Summit. Is that fair to say, Rabih?
100%.
Yeah. Okay. We would actually love to have you there. Check it out, dentistmoneysummit.com in June, Park City, Utah. Guys, this is great. Jake, Rabih, thanks for being here. Everyone, as always, thanks for listening. That was our 2 cents. Till next time. Bye-bye.